So what do they call that? I think it's like the alligator jaws is that sort of like chart pattern when the two assets diverge so much and investors expect kind of the jaws to close essentially. So that's interesting. Those are quite the jaws. Yeah, there's a huge divergence there.
One, two, three,
But
four.
All opinions expressed by Chris, Michael, and Ryan are solely their own opinions and do not reflect the opinions of 5i Research or i2i Capital Management. This podcast is for informational purposes only and should not be relied upon for any investment decisions. Employees of 5i Research may hold positions in the securities discussed in this podcast.
Welcome to the 19th episode of The Exponent with 5i Research. My name is Chris. I'm the head of research with 5i, and I want to welcome you, our listeners, to our journey into the heart of the Canadian markets. Our mission is to empower investors with precise insights and in-depth research into stocks, the economy, and more. With that said, let's dive into the Canadian and U.S. financial landscape. Today, I'm joined by my co-host, Michael. Welcome, Michael.
Yeah, thanks for having me as usual, and happy holidays.
Yeah, happy holidays to you too. Yeah, glad to have you. And it's been a while since we last spoke, and a lot has happened. We're looking at a new Fed chair now, so looks like Jerome Powell will be out in mid 2026, and the odds are right now between Kevin Hassett, Chris Waller, and Kevin Warsh. So interest rates are expected to fall in the U.S. And recently, we've had a big speed wobble in the AI narrative with concerns around OpenAI's ability to fund all of this CapEx spending. And we had some kind of odd comments from Sam Altman on a podcast with Brad Gerstner that kind of spurred a lot of those underlying concerns. And then with the strong year that we've been having, we'd sometimes get a Santa rally around this time, but at this rate, it might be postponed to next year.
Yeah. This year is like probably the exception for the Santa rallies.
Yeah, that's right. Yeah. Yeah. So we're
especially like today, we're talking like it's a red day in the market, and every AI stock is down.
Right. Yeah. Yeah. Even the big reliable ones are down. So yeah, how are you feeling about things? What are your kind of general thoughts here?
No, I mean like the market remain pretty like conservative and rational. It's not like YOLOing to the moon with every name.
Yeah.
But like so people are skeptical. So is it and a lot of people are concerned like whether we in this AI bubble, this or that. But like with valuations coming down and a lot of names coming down, like I think there's rationality in the market. And how about you? What did you say?
Yeah, I agree with those comments. I mean, I think for me, hearing a lot about the AI bubble concerns is almost like reassuring in some senses, because that does kind of confirm that we're getting some rationality. People are concerned, investors are concerned, and we've had, like tech valuations have actually declined from the start of the year to the end. And so there are chances that we could see some of the AI narrative start to fall apart, but that's definitely not my base case. I think that we see a multi-year kind of story playing out with this AI CapEx spend. I do think that this is one of the most like revolutionary technologies that we've seen, and I think there's going to be a lot of different themes to emerge from it. A lot of growth that we're going to see, like economic growth, stock fundamental growth. And I think that, the next couple to few years can be really good, fueled by AI. And so, I think we're seeing some decent opportunities, but the market momentum is certainly negative right now. There's a bit of rotation happening with some of the value stocks. So I think we need to, get a little bit of a sense of what happens in January, and then I think that helps to paint the picture. But definitely I remain pretty bullish. But I think investors need to kind of like pick and choose which areas they want to look at for sure.
Nice. Yeah, that's a good way to put it.
Yeah. So we've got like a jam-packed episode today. So we're going to start off with our usual, the Canadian small cap names. We are going to be teasing like an AI special report that we're going to be publishing to our members in the next month. I'm going to be going over a signal that I created on the market, and we're going to be talking about favorite stocks and sectors for 2026. And then lastly, Michael's going to be discussing an interesting ETF. So do you want to start with your Canadian small cap name?
Sure.
Okay.
Put that up on the screen. So the small cap names I'm find pretty interesting recently is Medical Facilities Corporation. So the ticker is DR. So it is a small cap name with like sub $300 million dollars in market cap, and it is a healthcare company that operates like specialty surgical hospitals and ambulatory like surgery centers in North America. And the business is quite stable over the years. Though growth is quite slow, company generates a very strong free cash flow year after year. And the interesting thing about like DR is that the company has been in the process of shrinking the business to like create value for shareholders. So like the market like continues to ignore the company's like cash generating capability. Like the company is trading like 3-4 times EV to EBITDA, which is quite cheap. And also DR has been in like selling assets at a higher multiple in private transactions and using that proceed to like repurchase shares in the public market at a much lower multiple. So and in fact the company has repurchased like almost 42% total shares outstanding in the last 5 years, as you can see in the picture. And the share price compounded at almost like 20% plus during that period. And today like valuation remains cheap, and management is committed to continue this playbook for some time. So we think like that this is a highly like risk reward setup in the current market, and could look interesting.
Nice.
So,
Yeah, no, that's a solid name. And like from a key, just a free cash flow profile, it's really interesting and attractive looking because it's distributing, dividends to shareholders, dividend yield of like 2.3%. And then also that huge buyback yield that you were talking about. And it's also paying down debt. In the last 12 months, it's done like 10% debt buybacks. So yeah, from its free cash flow profile, it's really basically putting that free cash flow to work. And that's a pretty interesting story. I like that. And it's trading at a cheap valuation as well. So that's interesting.
Yeah. And they buy back like 30% of their shares outstanding alone this year. So it should be something.
Yeah.
Yeah.
That's interesting. Yeah. That's a good name.
Yeah. And what's your pick for this episode?
Yeah. So I'm going a little bit like kind of AI adjacent theme here. A little bit, not so much robotics, but like battery tech sort of theme and grid. So this is Electrovaya, ELVA is the ticker. And this can be really thought of as not just energy storage for powering cars, but entire industries. So ELVA it's a lesser known Canadian battery innovator that could be at the forefront of the electric revolution. It develops and manufactures lithium ion batteries and advanced energy storage systems. It focuses on high performance batteries for, industrial electric vehicles, grid storage, specialty applications like medical and autonomous robotics. And it targets high margin industrial vehicles like forklifts, buses, automated logistics fleets. But it also has this other segment called stationary energy storage. And essentially this is, multiple batteries in a warehouse that can provide energy back to the grid when demand is high, and then recharge and generate and store more energy when demand is low for the grid. And that whole segment, that kind of, energy storage space is becoming really important because lithium ion allows us to store more power in a lower level of space, like a less space, and inject electricity back into the grid almost instantaneously. So it's a small company. It's about $433 million market cap. It's not cheap. It's trading at about 44 times forward earnings. But earnings growth is expected to be double to triple digits in the next few years. And its recent earnings were quite positive. It recently inflected positive for earnings. It has a small level of free cash flow. And yeah, I think it was marked its first profitable year. And we can see the chart here. It's revenue growth is really reaccelerating. That's the gray bars there. The profits, those are the green lines, orange line, blue line there. That's kind of its gross profit and net profits. And then EBIT margin is the very bottom bar graph. And we can see that that's, accelerating and inflected positive over the last year or so. So yeah, pretty interesting name in the kind of like grid energy storage and a little bit of like warehouse and robotics sort of industry.
Yeah, it looks pretty solid, especially like the top line momentum there. Revenue accelerates in recent quarters to like above 60%. And also you mentioned like this is one of their first times since they going public, like they close to break even. So it should be pretty interesting name going forward.
Yeah. I think it's also a name like in the right space in the right time sort of thing. It feels like so. I think there's a couple others in the Canadian market, like we have Tantalus Systems, Grid. It's kind of operating in a similar space, but not totally related. And so for in terms of like battery production and energy storage, there's not too many names. So I think in the Canadian market, at least, this will be kind of could become an interesting name. So,
yeah, I agree. Yeah, especially like the consensus estimate, like revenue growth will be strong, like 2-3 years from now, like 50% plus, I guess.
And certainly probably going to be a volatile name as well, but probably a volatile but high growth sort of play here. So yeah, that's my name. And so next, I wanted to highlight this special report that we're going to be publishing for our members over the next month. So this is going to be an AI compute stack special report just for our 5i members. So essentially, this is going to be a report that breaks down AI far beyond just chips and software. Here, we really map the entire AI compute stack. We look at, power generation and data center cooling to GPUs, networking, memory, cloud infrastructure, and even the upstream materials that make all of this possible. So the report highlights multiple stocks across each layer of the AI ecosystem, across both Canadian and US markets, and separates what's an AI core stock versus what's just AI adjacent. And the goal with this is to really help investors understand where AI capital spending is actually flowing and where it can flow to next. And just looking at some of the rotations within the AI compute stack. So this is just a brief kind of a one-page, example of part of the report. So this is like the first, layer that we talk about. And this is the, physical infrastructure and power layer. So we've got data center power and cooling. We highlight a few Canadian and US stocks. We look at, market cap, what sector they operate in, and then talk about the specific AI theme and how they relate to that theme. And then we keep going through different sub-segments of each of those layers. So you can kind of see blurred out like power generation, energy supply, et cetera. And so we go through several layers of the AI compute stack and talk about different Canadian and US names. And so, yeah, I'm personally really excited for this report to release to our members. I think it's highly useful and really kind of helps to map out, all of the different interconnecting pieces of the AI compute stack.
Yeah, I agree. Like when it comes to like AI, most people just know like Nvidia or Broadcom, TSMC, those large companies, Microsoft, etc. But like there's a lot of picks and shovels, like small cap names that look really interesting, and
Yeah.
not many people discuss enough about it. So I think this could be the chance for people to like gain knowledge about it and get more education about like all the value chains within the AI ecosystem. Uh, so yeah, that should be a pretty good report.
Yeah. Yeah. No, that's a great way of framing it. Yeah. So yeah. If everyone wants to keep an eye out for that, and hopefully we can launch that in the next month or so. So yeah, that's kind of a little piece on the AI special report. And then next, I'm going to be talking about a signal that I've created, and I'll give credit where it's due. This is something that I've created, and it's kind of modeled after something that Warren Pies has created, and his is a little bit different. He looks at kind of aggregate level levered ETF volume, but this one I'm really just drilling down to the NASDAQ 100, specifically looking at the QQQ. And so kind of what I'm labeling this as is like the retail conviction index. So it essentially compares how much money retail traders are aggressively betting on the NASDAQ going up versus going down. And that's using 3 times levered ETFs. So what it does is it looks at the notional daily trading volume for the 3 times levered long NASDAQ 100 ETF and the 3 times inverse NASDAQ 100 ETF. So, by using the daily notional trading volume, we can kind of see how many dollars are actually being placed on one side or the other. And then we use a ratio. So we're looking at, it's the 3 times inverse versus the 3 times long. And so as that ratio, which is in the bottom pane there, as that ratio spikes, that means that, a lot of investors are really placing, a lot of real dollars on the market going down, and in a big way, so much so that they're buying 3 times inverse ETFs. But conversely, when the ratio is really low, that's when they're placing a lot of dollars on, the NASDAQ 100 going up a lot. So they're betting, they're putting money on the 3 times long ETF. So they're hoping that it continues to go up. And so, when we look at this, we're kind of looking at extreme levels of the ratio. It's, we're kind of just trying to look at it from like a sentiment sort of position. So when that bottom pane, when the ratio is really high, it hits into that blue zone, which is, it's essentially 90% is the ratio. It's more or less an arbitrary number, but it is meaningful for the purposes of the signal. But when investors are placing so much money on the 3 times bear ETF relative to the 3 times bull, it's historically been associated with like large drawdowns in the markets. And that's when investors are, they're pretty confident. They think the market's going to continue to decline. So they're, placing their money where they think that it'll continue to decline and they'll make, they think they'll make a lot of money. So, this is zoomed out. This is kind of like the zoomed out view. But we can also drill down, and I've kind of zoomed in here a little bit more for better context. So, we can see the red zones. That's when investors are, placing a lot of money on the 3 times bull ETF. They think that the markets are going to continue higher. And we can see that really happened throughout 2020 to 2021. And it didn't always mark the top, because we can see like in 2020, there were some red dots there. But then later again, it happened quite a lot in late 2021, kind of marking like peak euphoria for the markets. And then conversely, we see that ratio really climb higher and go into the blue zone. And that's when investors were, really hoping for the market to continue to collapse. And so, for example, like the NASDAQ 100 went to a 35% decline in 2022. And this is where we can see investors were piling into the 3 times inverse ETF for the NASDAQ. So they were hoping that, they could make even more money by going inverse. And that provides this signal that, okay, everyone's a little bit euphoric and on one side of the boat, that they're so excited for the market to decline that they're hoping to make money by going, essentially short. And zooming in, again, we can see this is just the last 2 years of data. So we can see, early 2023, the market was bottoming and it was just coming out of that brutal bear market of 2022. And we can see that, the ratio in the bottom panel comes from this high level, and the bear euphoria starts to fade over time. And that happens as the index is rising. So, investors start to realize there's more money to be made on the long side. So they start, they put down the inverse shorts, and they basically start to go more 3 times long than they are 3 times short. And then we can see some spikes of bear euphoria. That's, earlier this year with the US tariffs in April 2025, we can see a spike there in the shorts against the long ratio. And then again, most recently in November, we actually had another spike hitting that blue zone. And both of those have marked, so far the bottom, at least local bottom in the market. So yeah, I found this indicator to be quite useful for certain markets, especially, for the QQQ. I've placed it against gold and some other assets, and it's been pretty insightful for looking at essentially when retail traders are, highly euphoric, either bullish or bearish.
Yeah, this is a pretty good signal, like for investors to know like where we stand in the market. Like usually people tend to like extrapolate whatever currently happened into the future. So if the current environment is like bearish, they expect it to continue
Yeah.
to be bearish for some time and reverse.
Right.
And that leads to like being long or short, like being bullish or bearish at the incorrect moment.
Right.
Like for example, most retail investors were super bullish on like at the end of the previous bull market, like 2021. So
Right.
yeah, I mean, what I can get from this chart is like sometimes it helps to be a contrarian. So being willing to like do something that different than the crowd is uncomfortable, but sometimes it's
Mhm.
like it's profitable.
Yeah. Yeah, no, it's a really, really good point, and exactly kind of what this metric is trying to state as well. And I also wanted to just put out an important caveat that this is just like a sentiment indicator, not necessarily a buy or sell signal, and especially not anything to do with buying or selling the 3 times levered ETFs. But yeah, this is I think exactly what you said. It's essentially investors get a lot of recency bias when the market's going up. They think that it's going to continue to go up, and then when it's going down, it's easy to start feeling like the market's just going to continue to go down forever, because at some point all of that sentiment starts to become entrenched in investors' way of thinking. But the market does turn, and it's cyclical, and that's kind of what this is suggesting as well. So
Nice one.
yeah, nice. All right, cool. So yeah, next we're going to go into our outlook for 2026 in the sense of a few favorite sectors and stocks. And so I think, Michael, do you have some favorite sectors or stocks you want to talk about for the next year?
For sure. Yep. So, yep. So, the theme that I expect could be like interesting for next year, 2026, is like oil. Like is highly contrarian now. Oil prices is like extremely weak since like
Yeah.
COVID pandemic. But the chart here shows that the price of gold and oil over the last like 40 years, and the two commodities prices tend to match each other over time. So before the recent divergence, like of gold performed so well, like both commodities pretty much provide an annualized return of around 4 to 6% on average. like slightly higher than inflation. But the most recent run up in gold prices, oil has lagged behind like significantly. And if history repeats itself, oil should have room to catch up on the upside over the next few years. And so even though the oil prices today as we speak is like around 55 56 USD, which is quite weak, but the classic quote, like the cure for low oil prices is low oil prices. This is because like low oil prices will be a self correcting force in the market cycle. So low price lead to like reduced supply, and because like oil companies do not find it economically attractive to drill. And oil, while in the short term, like oil demand remains relatively like unchanged. So the combination of lower supply and stable demand could lead to like higher oil prices. Again, this is a highly contrarian call, and it may oil price may continue to get lower before it starts to recover. But I think like the risk reward here, the setup here is quite attractive to have some exposure to the energy sector.
Nice. Yeah, I like that. Yeah, and it's so what do they call that? I think it's like the alligator jaws is that sort of like chart pattern when the two assets diverge so much, and investors expect kind of the jaws to close essentially. So that's interesting. Those are quite the jaws. Yeah, there's a huge divergence there. But yeah, but the pattern is pretty interesting because it is like they do follow a very similar secular sort of theme where, unlike even the markets, if you look at like the S&P 500 or the Nasdaq, they have these like kind of 4 to 5 year cycles of, really strong bull markets for a while, and then it kind of tapers off for like 1 to 2 years and then bull market again. But these are, really long elongated sort of cycles. And yeah, you can see like this huge ramp up into 2011 for both kind of commodities, and then they both fall into 2016 basically, and then there's a ramp up once again. So it's really interesting, and I've been thinking about oil and energy stocks as well. And I think for me, what I'm looking at is I'm kind of waiting to see when I can start to see some relative outperformance from energy stocks against, other unrelated stocks or just the broader markets in general. And I'm starting to see some signs of it for sure. Like, for example, Tamarack Valley Energy, TVE, KEL's another stock. Both of those are, quietly rising. I think TVE even hit like a new all-time high, I believe. So, which is kind of unusual when you see energy prices dropping so much. So, I think there's going to be some telltale signs for sure underneath the surface, and it's really going to be important for investors to kind of to watch for those, to watch for that relative outperformance play out. So yeah,
for sure. But like always leave room for error here. Like this time could
Yeah.
always be different. Like
Right.
I mean, like 20, 30 years ago there was no renewable energy, but this time like there's
Yeah.
the new force there is growing like leaps and bounds. So
Yep.
yeah.
That's a valid point. Yeah. Technology changes, and so too should investors. Yeah, I guess kind of themes and exposure to different sectors. So makes sense. Yeah. But yeah, I like it. Cool. Is that that's the theme for 2026 for you then?
Yeah.
Nice. I like it. Okay, cool. All right. Well, I'm going to go just two themes, no individual stocks really, but I'll talk about kind of two themes that I thought were starting to shape up really nicely recently. And so the first is consumer discretionary, the consumer discretionary sector. So this is the XLY ETF, which is US discretionary names. And it's this is the monthly chart, and looking at basically the last more than 10 years. And so we can see like it's looking pretty good here, like chart wise, everything's shaping up nicely. It's had an okay year. It's not certainly not as good as the tech sector. But for a cyclical sort of industry, you would think that it would have had a better year, which is why I think that we'll see a lot more positive action coming in the next year, as rates can maybe soften and go down. Bond yields maybe follow suit, which we really haven't been seeing too much recently. But if bonds follow suit in terms of bond yields, then we could see, the ability for individuals to borrow and take on, some increased debt. That can also help with consumer spending and things like that. And so beneath the surface, some of these names we have Tesla, Booking, and TJX, Lowe's, DoorDash, Ross Stores. And looking at the chart of those, they look pretty attractive here. Like the momentum's turning up. Tesla hit, a new all-time high for the first time in just about 4 years yesterday. DoorDash is a new one, but that's had some really good momentum. TJX is also doing quite well. And then Lowe's looks like momentum's turning as well. So beneath the surface, I'm starting to see some healthy rotation into that sector, I think. So that's the one. And then my second sector is financials. So this is the XLF ETF for US financials. And again, it's had a pretty good year, but there has been some consolidation in price over the past few months. But, I think we're starting to see a bit of a breakout here. And underneath the surface, a lot of those names are looking pretty good as well. Like, insurance names, credit card companies, asset management, asset managers are doing really well. Banks are already doing quite well, like JP Morgan, Goldman Sachs, et cetera. But you also have like some of the credit agencies and, data companies like S&P Global, so SPGI. Chubb is an insurance company. It's looking quite attractive. So yeah, I'm starting to see some decent opportunity there for sure. And so I think outside of tech, which I am bullish on as well, but outside of tech, I think these two sectors definitely caught my eye. So
Well, those two are interesting. Yeah, for sure. Like declining interest rates would help, like
Yeah.
consumer
Yeah.
discretionary sentiment, and for financials, yeah, you like a lot of rating agencies or like asset managers will benefit from declining interest rates too.
Yeah.
Like and also like the setup for financial is pretty attractive. There are a lot of insurance names still like did not catch up with the bull market. Yeah.
Right.
So yeah, room for the upside there. Yeah. Overall, I like the two. Yeah, should be
Yeah.
a decent picture.
Yeah. I think so. Yeah. It's more of like a cyclical tilt for sure. But if we think about like the cyclical sectors, we've got tech, communications, industrials, basic materials, financials, discretionary. So, tech, communications, basic materials have been doing really well this year. Same with, well, mostly just in terms of gold for basic materials. And then same with industrials. Industrials have been really hot on the heels of, with AI spending and things like that. So those cyclical sectors have done well. But when we look at, financials and discretionary, both being cyclical, they've kind of lagged all of those sectors. So yeah, I think this could be sort of like a potential catch up moment for those two sectors. So yeah.
Interesting for sure.
Yeah, cool. All right. Sounds good. And then lastly, I think you have one interesting ETF that you want to talk about.
Yep. So yeah, the ETF I want to discuss today is like what the investment industry usually refer to like risk adjusted returns strategy, or like minimal volatility ETF. The ticker is USMV. So what is risk adjusted returns here? So the investment industry refers to it like it is the hallmark of investing, like basically provide investor returns in up and down market, and like providing investor basically decent upside potential over time with minimal downside risk. And where can investors like find it? What industries, what names like really have that characteristics? So there are certain business models that demonstrate a high degree of predictability and resiliency even during economic downturns. So imagine like healthcare companies that provide essential care services to patients, or software companies that provide mission critical solutions for businesses to operate, or a utility company, the internet service, or even waste management business. So those companies are really resilient to like macroeconomic downturn because of the non-discretionary nature of their products or services, and with their predictability, these companies like tend to possess low business risk, and or investor usually call it like low beta stocks. Um, and while these names still like providing like fairly attractive returns over time. So what does it mean? Like why like minimal volatility strategy is attractive for like long-term compounding here. So companies with recurring revenue, like mentioned earlier, could be attractive investment vehicle for investor that seek like good returns with minimal volatility, and so owning a well diversified portfolio of these names could allow investor to compound capital in a steadier fashion. Like investors can imagine like the strategy is similar to like putting money in a saving account, and accept this saving account like represent businesses that earn much higher returns than a typical saving account, and could reinvest the dividends themselves. So these strategies could help investors sleep comfortably at night, by owning a well diversified baskets of these businesses. And the risk adjusted returns strategy is expected to shine during like volatile market. And the ETF like USMV here has done like basically just that. So since inception in like 2011, the fund never had a drawdown of more than 20%, except the pandemic. And here's some of their largest names in the holdings. Like it is a very diversified portfolio. So you can see some software names like Microsoft, Intuit, some payment processor like Mastercard, Visa, insurance name like Progressive, Berkshire, um, waste management company. So
Mhm.
like overall the theme is kind of attractive for investor. It's not like it will not provide sensational returns, but it provides good
Yeah.
returns over an extended period of time, um, with minimal downside risk. And yeah, so I think that is interesting.
Yeah. Yeah. No, I really like that ETF, and it's there's so much to talk about here too, and like so I was looking at the returns against the market. So like you said, it has historically had a lower upside than the broader markets, but again, muted historical downside as well. So like in the U.S. tariff April drawdown of this year, its drawdown was less than the broader markets, the S&P. And similarly with 2022, it had a shallower pullback as well. And it's also interesting to note too, because it actually has about 30% weighting towards technology, which is its highest weighting. And, that's kind of is almost similar to the S&P 500's kind of weighting towards tech, but yet it's weighting towards more of those defensive type technology names, as well as, in a more equally weighted sort of method versus the S&P, which has, huge weightings towards the Magnificent Seven names, whereas this one's going to more equally weight them. So that's really interesting. And yeah, I mean, just looking at this list, it's a lot of really, classic, household type of names. And then, yeah, waste, I think you mentioned Waste Management, but Waste Management, I think recently announced like a dividend hike of 14% or something. And the stock has been doing well, and we're seeing some rotation there. And so, yeah, like I think that's a pretty attractive looking name.
Yeah. I mean, the strategy itself is quite boring, but boring and works like over time. So
Boring is good.
12% a year in a bull market may not look that exciting, but if we enter a challenging period of flat or down market, then like 12% looks like exceptional.
Right.
Yeah. So I think it could be one of our idea investor find interesting.
Yeah, no, I like that. It's a really good name, and it pays like 1.5% dividend yield, and a pretty good AUM as well. It's about 22.5 billion, so it's quite liquid. Nice, yeah, looks great. 175 holdings, nice, yeah, cool. I like it. Good ETF. It's awesome. Yeah, so I think that's about it for today. We're at just around 40 minutes. Yeah, that's all that we have for today. We hope you enjoyed this episode of our podcast and learned something new about the Canadian and US markets. If you want access to more exclusive content and insights, don't forget to visit our website at 5iresearch.ca and sign up for a free trial if you haven't already. You can find the link in the show notes below. And if you like this episode, please give us a thumbs up and subscribe to our channel for more updates. Thank you for listening, and we'll see you next time.